Good morning, everybody. Dan Kautz.
Good morning, Jeff Buckley.
And I've been watching a little TV, and I don't want to be surprised it's February. So from now on, it's going to be 1 down, 11 to go. I'm going to do a little Don Cherry, maybe.
Oh, all right.
I'm going to have to get a new
sport coat.
Yeah, I don't have my sport coat on today. We're in the middle of winter. We're pushing cars around and in the middle of all this salt everywhere. So I dressed down a little bit today. But I was thinking about it. I think maybe because of the color commentary, I think I will start looking like Hockey Night in Canada back in the old days, huh? Let's get into it here. Quick check-in. Jeff, you do such a great job in putting this stuff together every month. I want to thank you for that. And I just want to go over our contact information. Of course, we can't take any calls or texts or chats during the recording of this. Our contact information is dkautz@kautzbuckley.com, jbuckley@kautzbuckley.com. Office phone number 716-276-8480, and the ever-popular text number is 716-272-1129. Please remember, if you're contacting us for a business issue, contact us through the text line. A lot of our friends and families we also do work with, and we just want to make sure that, hey, business stays on the business line, we're getting together for drinks stays on the other line. And of course, we've gotten quite a bit of traction on our socials, Facebook, LinkedIn. You can follow us on there. And we've also been reworking our website quite a bit to be a little more friendly and some more information and videos on there. So please check in.
Well, and we do have some events coming up too. We're working on our Retirement by Design presentations that'll be starting here in the next few weeks. And the way we like to get information about these events out to all of our clients and anybody else that might be interested is through LinkedIn and Facebook. And so please do follow us on there if you get a chance, because then we know that you're receiving these notifications when they do hit those sites. So
and mentioning Retirement by Design, our most popular event that we have for our new clients and clients is you can register right online on the website, top right-hand corner. Right. Okay, so tell a friend.
Yeah.
There you go. Let's get into
That's good. Well, yes, and as always, we'll start with a little bit of a look in the rearview mirror. How did we come through January, the first month of the year? A good month, really, pretty positive all around. In fact, kind of something that we have not seen for a very long time. If you look, the worst performer in the month of January was the Magnificent Seven, and we've talked a lot about them. Certainly that's the Microsoft, the Apple, Google, the large tech companies that are really driving a lot of the spending on artificial intelligence. But the markets have really started to rotate out. A lot of the money managers that we work with are saying that, hey, they're seeing some great opportunities in stocks that are outside of the Magnificent Seven, and they're starting to use our clients' money to diversify their portfolios and get into some of these other stocks. Some are paying nice dividends. Some are seemingly undervalued when compared to some of their Magnificent Seven brothers and sisters there. So that's it. But yeah, so a good month. Small, mid cap, and value leadership is. We did see a lot of movement into the small caps. We'll see if that continues or not. But again, small cap is really, that's the Russell 2000. Just those are the companies in our economy that are smaller. Those aren't the behemoths like ExxonMobil, Johnson & Johnson, Microsoft, Apple.
Coca-Cola's.
Yeah, those are the companies that are a little bit smaller. And that's seen as a positive sign because if the economy is doing well, they generally do well too.
They lead the way out, they lead the way down.
Yes, that's it.
So it's nice to see them leading the way out. It's a positive sign.
Yeah. So that's it. So this again just kind of focuses then on the sectors. So we're drilling down just a little bit more and saying, okay, of all those stocks that are out there, what sectors really seem to benefit? Energy, technology.
I'm sorry, I didn't want to jump.
No,
that's interesting that they're down on the bottom. Go ahead.
Yeah, technology is one of the worst performers, really, in the month of January. And you can see, really, it's kind of been a 3-month theme here. So it goes back even into 2025. But energy has been a very strong performer. There's a lot of additional capital flowing into energy companies, and there's a number of different kinds of energy companies. There's those that are really public utilities, and then there's also their private energy companies as well. And there's kind of a general recognition across the board that we really need greater energy production. We're starting to see it with artificial intelligence and the build out of these data centers, which is where all the computing work goes on for artificial intelligence. We're building these, but they need to be powered, and they really draw, they draw a significant amount of power because of the need for cooling. So we're seeing a lot of money flowing into the energy sectors, which traditionally had been kind of a sleepy area. A lot of people would purchase them just for the steady dividends that public utilities pay. But this sector is now expanded really even into the private markets.
You know, it's going to pull a little off of topic, but I'm good at that.
Yeah.
When we talk about speculation, or in this case AI, I want to be in companies or chips that specifically are driving the AI, and we've been talking to clients about it. We use a term that we want to buy around the actual speculative product. In this case, AI may be speculative. It's unknown, it's going, but everybody's going to need the energy.
That's right.
It's the joke about the miner who shows up to Alaska, and before they can go and actually speculate and hunt for gold, they have to do what? They got to buy some Levi Strauss. They got to buy a horse. They got to buy a pick and an axe, right? Yeah. So that's called building around the actual speculation, and it's a more safer place to play, because no matter what, the vendor that sells them that, did they make the money? No. That's why Levi Strauss is, that's where they made their dough, right?
That's
so
right.
Energy and metals. I just wanted, we get a lot of questions about that. Do we buy gold? Do we buy, the actual chip? Buy around, you're going to be safer.
Right. And again, these, as we talk with the money managers that we work with that are managing the portfolios, this is what they're looking at. They're buying around they focus on the themes and then buy around those themes. So yeah, kind of interesting. Now this again this is where we're looking kind of right out the windshield, what's coming right in front of us here. This is just really different portfolios. So again, what we've talked about before, a lot of focus on stocks, quite frankly, not much on bonds. But this is our way of being able to take a look and see something that's much more akin to your portfolios. Again, the more aggressive investors, 80% equities, 20% fixed income. Somewhere in the middle, 50-50, 65-35, and then the most conservative investors, probably somewhere around only about a 20% allocation to stocks or equities, and the balance 80% on fixed income. But you can see, the year-to-date doesn't show us much. That's just a one-month performance. But even the bond category, a conservative investor was up about 1% during last month. The 12-month period, if we go all the way back, I mean, again, you can definitely see the difference. There was a risk-reward there for stocks.
That's going to point out. But if you notice, over the last 12 months, how much more reward are you getting for that, step out in risk?
Yeah.
I think this is going to lean more towards the volatility that we're going to see in the market. It might be time to go from, it's 80-20 and sitting at 70-30.
Yeah, exactly. And I mean, again, that's a good point, the difference there, because a lot of our clients would fall pretty close to this category, about 65% equities, maybe a little more, maybe a little bit less, but in there, and then a 35% allocation to fixed income. But one of the big themes lately has been that fixed income has really been holding up its end of the bargain too. We're getting decent yields there, and they've been really kind of holding pat with their valuations too. So not a drastic difference when you step up that risk ladder. So it's something certainly to look at. So yeah, and then the next slide, now this is kind of looking down the road a little bit. This is one of the money managers we work with, Rockdale. This is their view every month on what maybe the next 6 to 9 months might bring. Mm-hmm. Yes. And it was interesting. Last month we saw a little bit more green. There was a little bit of a step back here, and we see that like in consumer sentiment. Not quite as strong as it was right toward the end of the year. Fiscal policy, there's some concerns out there.
Federal Reserve Chairman,
right.
Different policies that are going to be going through Congress. Yeah. Go on.
Well, no, I was just going to say the Federal Reserve is a big point, because the naming of a new Federal Reserve chairman. Now, he's not going to take over until May, but what we know now who's coming in, or at least is being nominated, and it looks like he'll probably receive approval through the Senate, because unless politics are entering into the game.
That's
Yes.
my look at my face. If you, I can't remember Tillman, I believe.
Tillman he's a Republican
and
senator.
said absolutely, I will not approve until we drop the suit against
Right.
Against Powell. Which that's all inside baseball political crap. But
it is.
And also, what's nice with the new Federal Reserve Chairman, it seems to that some of the other names that were floated earlier. This one seems like the Fed's going to keep its independence.
Oh,
which
yeah,
is
I think definitely
crucial.
Right, and I think generally speaking, I think there's a lot of people out there that watch the markets very closely, and they breathed a little bit of a sigh of relief when he was nominated. Now, again, not getting into any politics or anything, but yeah, I think the thought was that some of the other potential nominees may have been a little bit too closely tied to the current White House, and that would have really raised questions about the independence.
Just throwing their names, you saw what happened on the market a few
Yeah,
weeks ago. So
definitely.
let's not get too far off topic, but there is something I wanted to point out here. Just going to talk a little bit about volatility coming up in the market. And there's no doubt we all experience volatility, and it looks like some's coming our way. And I think an indicator of that is when you look at consumer sentiment, you see how it stepped back, but consumer spending hasn't moved.
Right.
This is why I point that out, is consumer sentiment is an emotional reaction. Consumer spending is a true reaction. That's where actions are stronger than words, right? So consumers are still spending. The question is which consumer? And it's usually the more affluent consumer. The lower economic consumer not maybe. They're feeling the punch, they're feeling the crunch. And that may be where they're answering the sentiment is bad, but the higher, the wealthier spenders are like, well, we're still spending.
Yes.
So actions and words, that's going to be interesting, and that leads right into volatility. And that's going to go into the midterms. So why don't you take a look at this?
Well, as I was putting everything together, I came across these slides are actually all, again, I read quite a bit, scan a bunch of different sources here just for some interesting information, but this was something that was put out by the American funds, Capital Group, which is the American funds. And they had something about how the midterms will affect the markets. Now, probably everybody's saying, oh my gosh, it's only February. Do we have to keep talking about politics? But what we're trying to figure out is how the midterm elections, which are coming up in November, certainly months and months away, but the impact of those elections, all the posturing that we're going to start hearing, the rhetoric and everything, that does begin to have an impact on overall financial markets much earlier in the year. So yes, as much as we all may be a little weary of politics at this point, it is something to consider. So this was, I thought, kind of an interesting piece to just kind of keep things in perspective with respect to the financial markets. Now, so the question, how might the midterm elections influence the stock market? Well, the president's party typically loses seats in Congress, and that's been a pretty consistent theme.
Yeah.
There's only been a few years here over the last number of years, really, presidential cycles.
All the way back to 1934.
Yeah, exactly.
This is good data.
Almost always, and we all know how close the majorities in both the House and the Senate are currently right now for the Republicans. So a swing of even a couple seats at this point could certainly change the entire balance of power, really. And then that affects what fiscal policy and what really a lot of policies on different fronts can get through Congress. So that's kind of shows that's probably what we're looking at coming down the road. So
with that said, what you're saying is the early seed of this early in the year that's what's going to sow some of this volatility we feel.
Yes, it's probably going to start. There's anticipation of that. There's things. So the concern is, all right, what's the actual impact that this seems to happen? So historically, if we take a look back, in the initial months of midterm election years, stocks have historically generated lower average returns and often gain little ground until shortly before the election. So that's kind of a nice quick summary to say, look, we've got an entire year here and we're just getting started now, but we're already seeing some volatility. Now, I'm not going to peg the current volatility we're seeing at the beginning of February here to the midterm elections. There's a lot of other things going on. But volatility, I think, is going to be a theme of this year. Yep. And I think this kind of shows that, as we get closer to the election, it's going to start to become a little more obvious as to how things might shake out. And the markets tend to understand that and respond to that. So even before the election, we may start to see some recovery here in the markets if we've experienced significant volatility leading up to that. But the point is, the returns generally are usually a little more muted in the months before.
And then after the election,
yes, yeah.
we know where we stand and away we
Definitely,
go.
yeah. So the theme, expect some volatility this year.
And let's get through it. Here's exactly what you were saying, how the volatility will happen before, early on in the year, and then after the election it takes off. So why don't you?
Yeah, no, this is it exactly. I mean, it's just kind of the same theme here, and it shows this is an entire calendar year at the bottom of the chart here. So you can see, we don't do too well, and in fact, we start to drift off a little bit, historically speaking. This certainly isn't a guarantee of what's to come, but what's happened in the past is those early or late spring and kind of early summer months tend to be a little bit more difficult, a little bit more volatile. And then once the election approaches and then passes, then the markets seem to get their footing underneath them again.
And then this top chart is the gray bars any other day besides a midterm election.
Yes,
right,
exactly.
And I also like to point out this data sample, 1931.
Yeah.
This is not, hey, what happened last week? This is some serious data crunching and some good information. And here we are talking a little bit more about the volatility during the midterms.
Yep, they have come with higher volatility, so they spikes in the months leading up to the midterm elections. And these are kind of the volatility readings here, really. Mm-hmm. So not unusual, to be expected. But again, maybe it's time to repeat our famous line.
You got it. I was just going to tee you up for it. Jeff, what do you say all the time?
Well, that said, again, the secret really, I think, to investing is it's focusing on your time in the markets and not your timing of the markets, because it's almost impossible to time the markets. There's so many factors that contribute to how the markets are going to move. But staying invested, staying in the markets, historically speaking, and the data certainly supports it, you're going to more than likely you're going to end up higher than when you started.
Yep,
So,
and good job, Tommy boy.
yeah, yes, that's right. So yeah, this is just really this would be kind of in support of that. The post-midterm market returns have been strong. Yep. So this shows after we get past that midterm election, then we're in the third year and into the fourth year of a presidential cycle. We've got the power divided, how it's going to be divided for those remaining 2 years. And we've been able to respond to that pretty positively, really just about historically speaking. I mean, 86, 87 was a little bit of an outlier there, but otherwise market returns have been pretty decent in those following years.
So the theme of the year, again, is it's time in the market, not timing the market.
Right.
And my favorite feeling is don't get emotional. Elections are emotional. Data is the number we have to follow.
Right.
And I think we've pointed out that you've got to have fortitude going through this year. We're going to have ups and downs, but we have really strong portfolios. We have strong money managers and pickers and research behind it. Just we got to have to march through this year.
Yeah, and the perspective,
and I think we're going to be really turn out pretty well.
Yeah, well, a lot of the money managers they look at these years as opportunities too. Again, we've talked about kind of the breadth of the market, the spreading out. They're taking advantage of this volatility and to strengthen your portfolios to support hopefully higher growth here.
And I think this is where the stock that you pick is going to be more important than the sector that you're in.
Yeah.
So individual stocks and bonds will probably be a very strong tool to use against some of this volatility.
Yeah,
so that brings us on. I want to thank everybody for joining us. Stay safe out there. I wish this week I could say go Bills, but we just didn't make it this year. So take care. Have a great month.
Thank you.
Bye-bye.